Hello everyone, I hope you guys are doing great and your studies are going in full swing. Now in today's class, we would be doing a full revision for Ind AS 36, impairment of assets is a very important standard along with the important questions. So let's get started. So when we look at Ind AS 36, to what category of assets does this apply? It applies to PP under Ind AS 16, intangibles Ind AS 38, even investment property under Ind AS 40, goodwill under business combination, and also investment in shares of subsidiary associates and joint ventures in the SFS. Now, why do we need a separate accounting standard? Because when we look at impairment, items like inventories, financial assets, etc. have impairment provisions or write-off provisions embedded in their respective standards. But when you look at PP inventories, PP intangibles, etc., you measure them at cost less accumulated depreciation. So you don't really compare them with the value that these assets are capable of recovering as on the balance sheet date, and hence you can check for the recoverable value for these impairments. So how do you test for impairment? You compare the carrying value, that is a ledger balance, with what you call as a recoverable value. Now recoverable value is calculated as the higher of the fair value less cost to sell, also called as the net selling price, or the value in use, which is the present value of future cash flows. Now when you calculate the net selling price, the cost to sell will be the incremental expenses that you will incur to complete the sale, whereas the fair value, value in use will be based on the present value of future cash flows, where the cash flows over here will be before interest and before tax. You will discount them with the pre-tax weighted average cost of capital, which is also before tax. Now, when we look at, let us say, your value in use, usually, unless given otherwise, 5 years would be the maximum period that you should take for predicting the cash flows. Having said that, if a longer period can be justified, you can take that, but 5 years is generally the period that you should be considering. While considering the cash flows, you should also include the effects of inflation, the effects of salvage value, and regular, let us say, expenses like repairs and maintenance. When we try to find the recoverable value, you will take the higher of the two because that is what the asset is capable of recovering. Now comparing the carrying value and the recoverable value, if your carrying value is 100, the recoverable value is 80, then 20 is an impairment. If your carrying value is 100, recoverable value is 120, there is no impairment. Impairment is a one-sided adjustment. It will be accounted for if your carrying value is greater than the recoverable value. Now how do you account for impairment loss? It will first be adjusted against the balance in the revaluation reserve, if any, and excess, if any, will go to the profit and loss account. Impairment, one needs to remember, is a reduction in the carrying value of the asset, and hence if the carrying value of the asset falls, that is what you treat as an impairment. Now, impairment exercise has to be done only if there are indicators which are existing. It need not be done at each balance sheet date except for 3 items where annual impairment testing is required. That is intangibles with an indefinite life, intangibles under development, and goodwill. All of these 3 are lacking physical substance, and they are something where you do not amortize, and hence you test it for impairment annually. For every other eligible asset, you will test it for impairment if and only if the indicators exist. So indicators over here can be external, like a legal ban, like new technology or entry of a strong competitor, lockdown, etc., or it can be internal, like continued cash losses, or even let us say something like physical damage due to flood or earthquake can be your indicators. And if and only if there are indicators, which is again a subjective assessment, if and only if there are indicators, will you actually go ahead and do impairment testing. Otherwise, you don't need to separately do impairment testing. Now, when we look at this value in use, we have discussed the important parameters, like it has to be pre-tax, pre-interest cash flows, pre-tax WACC is a discount rate. Other important things is if you have a foreign currency cash flow, you will discount these foreign currency cash flows at the foreign currency discount rate to find the value in use, for example, in foreign currency, and then calculate the impairment. Also, if there's a site restoration obligation, you will have to ensure that the carrying value that you take is after the site restoration obligation, because unless given otherwise, the fair value less cost to sell, that is what a buyer is willing to pay, or the value in use will be after your present value of site restoration, and hence the carrying value that you use for comparison should also be after the present value of site restoration. Further, if you are planning to implement new technology or you are planning to do some restructuring or reorganizations, these restructurings and reorganizations can result in better cash flows, but you will not consider them till the time you are committed to the restructuring or reorganization. And your other items like inflation should be considered for the purpose of value in use determination. Now, once you impair the asset, is it possible to reverse the impairment loss? The answer is yes. you can do a reversal of impairment provided there's an improvement in service potential, that is either your value in use, that is the cash flows increase, or your discount rate falls, or your net selling price increases. If there's no improvement in service potential, you cannot book a reversal of impairment. Further, you cannot reverse impairment on goodwill because that will tantamount to recording what we call as a self-generated goodwill. While you are doing reversal, a few steps that you need to remember: you will first try to calculate the carrying value had there been no impairment, compare it with the recoverable value and select whichever is higher. Select whichever is lower, because that is the value at which your asset can be shown after a possible reversal. You will compare this with the actual ledger balance, which is after your actual impairment and after actual depreciation, and the difference between the two will be taken for the purpose of reversal. Next, you go to the concept of cash generating unit. All that we've studied till now is for an individual asset which is capable of generating a largely independent cash flows. But sometimes what happens is your individual asset may not be capable of generating a largely independent cash flows, and hence you have to go to a group of asset setup, where you look at a company which has a assembly line, a line of machines which work together to generate a cash flow. For the cases of assembly line, you cannot have an independent cash flow for an individual asset, and as a result over here you will go to the concept of cash generating unit, which has three essential ingredients. First, it is the smallest group of identifiable assets. Second, which is capable of, and third, generating a largely independent cash flow. So there may be a group of 4 machines which can make a bottle of Coke, and that can be a cash generating unit. That can be in one factory. There may be 10 such factories. Your cash generating unit can be just those 4 machines inside a factory which are capable of generating a largely independent cash flows. Secondly, we need to look at what we are capable of generating. Like for example, there may be a mine who is generating iron, and I'm selling it to my other factory who's using steel. So I'm not really selling the iron in the market, and hence I'm not generating actual cash flows. However, iron ore has a market, and hence this mine is capable, if it wants to, of generating a cash flow which is largely independent even if I don't have a steel refining unit. So I should be capable. Actual sales don't matter, capacity to sell does matter, and generating a largely independent cash flow, which means there may be a group of assets. If the cash flows within the group of assets are dependent on each other, they together form a single cash generating unit. Now, if you look at allocation of impairment loss, in case of a cash generating unit, you will first try to find the carrying value of the cash generating unit, which will include the carrying value of the individual assets plus allocable goodwill plus the allocable corporate assets. Corporate assets over here can mean assets like your head office or research and development center or training center. How will you allocate these corporate assets to each cash generating unit? If they are allocable, you will allocate them in an appropriate ratio. Usually the carrying value of individual cash generating units into the life of those units will be the best ratio. If the useful life of those cash generating units are not available, then you can allocate in the ratio of the carrying value provided they are allocable. Again, the comparison over here will be with the recoverable value, which is determined in the same way, and the difference will give you impairment. This impairment will first be attributable to goodwill, and excess, if any, will be attributable to all other eligible assets, including eligible corporate assets pro rata. While you are doing this working, a couple of things that you need to remember is when you calculate the cash generating unit can also include items like inventory, which per se are not covered by impairment provisions of Ind AS 36. However, if the management thinks that inventory is a part of a cash generating unit, well, it will very well be a part of the cash generating unit. However, when you do the impairment allocation, you will not allocate any impairment loss to inventory because it will automatically be recorded at the lower of cost or NRV as per Ind AS 2. So basically, for items like inventory, you will include them in the carrying value, because if the management believes that it is a part of CGU, its effect would also be there in the recoverable value. However, while calculating impairment, you will first allocate to goodwill and then to all other eligible assets. Inventory, etc. is not an eligible asset in the ratio of the carrying value. Again, while doing this allocation, you should ensure that after the allocation, the value of these individual assets should not fall below their individual recoverable values. There's an example over here that is discussed. Then you have reversal of impairment loss for a cash generating unit. You will follow the same principles. Reversal can happen only if there's an improvement in service potential, and there is no reversal of impairment possible in case of goodwill. Again, after the reversal, you should ensure that the value cannot exceed the carrying value of the individual assets had there been no impairment, or recoverable value, whichever is lower. Okay. Next, you can have a possibility where there are corporate assets or even goodwill, as a case may be, which is unallocable. That is, if the question tells you that they cannot be attributed to individual cash generating units, well, they cannot be. In such a case, how will you do the working? You will see that if there are any allocable items, if there are allocable items, you will allocate them to the smaller cash generating units and then calculate the impairment loss for these individual cash generating units, which is before any unallocable items. So this is a smaller CGU impairment testing. After you have done the smaller CGU impairment testing, each of those CGUs are already at their carrying values or recoverable values, whichever is lower. Now you need to do impairment testing also for the unallocable assets, but they cannot generate an independent cash flows. You cannot allocate these to individual CGUs. However, you can allocate it to the company as a whole, and hence you will try to calculate the carrying value of the company as a whole. While you are trying to calculate the carrying value of the company as a whole, you will include the carrying value of these individual unallocable assets as well. Compare it with the recoverable value of the company as a whole, and technically allocate the impairment loss. One needs to remember that none of the individual CGUs will bear this impairment loss because they are already at their carrying value or recoverable value, whichever is lower, so they cannot take it further, and hence the loss, if any, will be attributable to unallocable corporate assets only. So you have to do a two-level impairment testing, one where you do impairment for the smaller cash generating units, and then you do impairment for the company as a whole, which includes even the unallocable corporate assets. We'll do the sums on these as well. And the last part over here will be impairment in case of consolidated financial statements, where you might have a possible full goodwill or partial goodwill. What do you mean by full or partial goodwill? When you do impairment testing, let us say for subsidiary. In subsidiary, you consolidate all assets and liabilities at the full 100% value. However, because you have control. However, if you own only an 80% stake, then 20% is attributable to a non-controlling interest, also called as NCI. Now, this NCI can be measured either using proportionate net assets, or it can be measured using fair market value. Now, when you study Ind AS 103, you will find that the goodwill can be calculated in one of the two ways. It can be full goodwill, where you take purchase consideration PC plus NCI, non-controlling interest, at market prices, less the net assets, 100% of the net assets. That will give you goodwill for the entire business, because the premium for the 80% stake is there in PC, and the NCI also you have taken at fair value. So the premium for that 20% stake in the NCI is also there in your NCI, and hence the goodwill is a goodwill for the entire business 100%. On the other hand, the second method is NCI using percentage of the fair value of the net assets taken over, in which case NCI is a direct percentage of the net assets which are taken over, and hence there is no premium which is included in the NCI, and hence the goodwill that you get will directly be what you call as a partial goodwill. You will study this at a lot of length when you do business combination. So when you do this working for, let us say, the partial goodwill or full goodwill, and there's an indicator of impairment in the subsidiary as a cash generating unit, you will try to find the carrying value of the CGUs in the subsidiary or the subsidiary as a whole. While you do that, you will take the carrying value of the individual assets in the subsidiary, that is already 100% in your CFS, plus the goodwill. Now, in case of full goodwill, you will take the entire goodwill, that is 100%, but in case of partial goodwill cases, your goodwill will just represent 80% of the goodwill. When you compare it with the recoverable value, one needs to remember that recoverable value is based on the present value of future cash flows that will be calculated irrespective of whether you have accounted for goodwill in your books as full or partial. And hence the recoverable value will be for the entire business, and it will implicitly have the value for the full goodwill. And hence, in order to make it comparable, we will have to gross up the partial goodwill, if any, and recognize what you say as unrecognized goodwill. So over here, you will say that if your goodwill for an 80% stake that you hold is, for example, 800, then for the remaining 20% stake, there will be an unrecognized goodwill, let us say using a cross multiplication method, unless any other method is given, will be 200. And hence your full goodwill will be 1000, and along with the other carrying value of the assets, you can then compare it with the recoverable value, find the impairment, allocate the impairment first to the goodwill and then to the other assets. When you allocate the impairment to goodwill in case of full goodwill cases belongs to parent and NCI both, and hence the impairment loss will also be attributable to parent and NCI both. Other assets are always 100% consolidated, they are attributable to parent and NCI both, and hence their impairment loss is also attributable to parent and NCI both. However, in case of partial goodwill, you may have taken 1000 for the purpose of impairment calculation. However, when you recognize impairment, for example, if your entire goodwill is impaired, you can recognize impairment only towards that part of the goodwill which is appearing in your books. You cannot impair a non-existent asset, and as a result, your impairment loss will be only attributable to goodwill which is attributable to the parent share. You cannot impair an unrecognized goodwill, and hence NCI will not bear any share in the losses. We will do a sum on that which will give you a better understanding. And lastly, for other assets, that is always requiring 100% consolidation, and as a result, out of that 100%, you will attribute the losses to parent and NCI both. So that is a quick, I would say 15-minute concept revision for Ind AS 36. We will try to do 3 important questions. Each of these in some or the other way have even come in your exams. So if you look at the first question, this is a very typical question number 1, a very important one. We will just discuss this, and this is applying the concept of impairment in case of a cash generating unit. So if we quickly discuss this, there is an LEA Limited, a manufacturing company which deals into manufacturing of cold drinks and beverages. It is having various plants across India. There's a machinery A in the Baroda plant which is used for the purpose of bottling. There's one more machinery, that is machinery B, which is clubbed with machinery A, and machinery A can individually have an output and can be sold independently in the open market, whereas machinery B cannot be sold in isolation without clubbing it with machinery A. It cannot produce an output as well. Like for example, let us say there is a machinery A which is capable of manufacturing petrol from crude oil, and there is a machinery B which is like a filter, that if you put that filter on machinery A, the petrol that you get is high speed petrol. Now machinery B alone is just a filter, it cannot generate an output, but machinery A can also generate petrol without having the filter of machinery B as well. Now let us say your company is exclusively in the manufacturing of high speed petrol only, in which case the management can subjectively assess that your cash generating unit is a group of machinery A and B. Yes, machinery A can generate cash flows, however in your business you are only manufacturing high speed petrol, so your cash flows are the cash flows generated by A and B together, and hence if the management says that the CGU is A and B together, well, it is A and B together. It is a subjective case to case assessment. The company considers this group of assets as a cash generating unit, and an inventory amounting to 2 lakhs and goodwill amounting to 1.5 lakhs are also included in the CGU. So when I look at the CGU, it includes machinery A and B as given in the question. Inventories can also be a part of the CGU if the management contents, as well as goodwill. So there are 4 items. Machinery A was purchased on 1st April 13 for 10 lakhs and there's a residual value of 58,000. Machinery B was purchased on 1st April 15 for 5 lakhs with no residual value. Okay, if you read the entire question, you are probably trying to do impairment as on 31st March 2018. So if machinery A was purchased in 2013 with a 10-year useful life, 5 years have gone by. If machinery B was purchased on 1st April 15, again with a 10-year useful life, then 3 years have gone by. The useful life of both machinery A and B is 10 years. The question very clearly tells you it is 10 years. Some students also say that machinery B cannot be used for machinery without machinery A. Well, but after 10 years, when machinery A is at the end of the useful life, you can always buy a new machinery A and continue using machinery B. Okay. The company expects the following cash flows in the next 5 years pertaining to machinery A. Remember, these are cash flows only pertaining to machinery A, and the incremental borrowing rate is 10%. So if I want to find what is the carrying value of my cash generating unit, I can say there is machinery A in my cash generating unit. For example, if I look at machinery A in my cash generating unit, what is the carrying value? Well, I started at 10 lakhs and then I will subtract depreciation, that is 10 minus 0.5. This is 50,000 residual value divided by 10 years, out of which 5 years have gone by from 2013 to 2018, and hence if I do this working, I will probably get 5.25. You can do this calculations, it will probably come to 5.25. Similarly, when I look at machinery B, I purchase this machinery at 5 lakhs and then 5 divided by 10, that is 50,000 of depreciation for 3 years from 2015 to 18, and hence this will come to probably 3.5. Inventory must be measured using Ind AS 2 that is at 2 lakhs and goodwill is at 1.5 lakhs. So if I total all of this, this is 5.25 plus 3.5 plus 2 plus 1.5, and hence this will come to 12.25. This is the carrying value on 31st March 18 for your cash generating unit. Now you need to compare this with the recoverable value. So someone will say, chalo, recoverable value is given as a present value future cash flows. Remember, this is only for machinery. We want to find the recoverable value for the cash generating unit. On 31st March 18, the professional valuers have estimated the current market value of machinery A is 7 lakhs. Okay, so this is also for machinery A, 7 lakhs. The valuation fee was 1 lakh. Now this is a very interesting case. Valuation fee is not an incremental expense to sell. So it is linked to valuation, not to sell. So even if you don't sell, you still have to pay the valuation fee, or you must have paid the valuation fee, and hence this is not called as a cost to sell. However, the other items like dismantling the machinery, which incurs 1.5 lakhs, specialized packing cost of 25,000, and legal fees are all to be incurred only if the machinery were to be sold. So if I look at machinery A, and if I try to find the fair value as cost to sell for machinery A, I will take the fair value, which is 7 lakhs. From this, I will not subtract 1 lakh, but I will subtract the 1.5 lakhs, which I will have to incur if I were to sell. Subtract 0.75 as well as 0.25. 1 lakh will not be subtracted, and as a result, this is what, approximately 4.5. So this is my fair value as cost to sell for machinery A. Now, if I want to find the value in use for machinery A, I will take the discounting factor as given above at 10%, 1 lakh 50, 1 lakh, 1 lakh, 1 lakh 50, and then I have 1 lakh excluding the residual value. Somewhere at the top you have been given that the residual value of machinery is 50,000. This must be cash flows from the year 2000 and 31st March 18 all the way up to 31st March 23. Residual value of 50,000 will be added over here. You will apply the discounting factors at the rate of 10%, so that is 0.9091, 0.8264 and so on, and you will try to find the value in use. I think this comes to around 4,88,000 and something. You can do this working, but I'm just doing a direct 4,89,705 approximately. So this is 489,705. You can do these calculations to find the value in use. Now the inventory has been valued in accordance with Ind AS 2. So whatever is the loss, if any, is already recorded as per Ind AS 2, and the recoverable value of CGU is 10 lakhs. Finally, you have been given the recoverable value of the CGU. So this is a carrying value of 12.25 lakhs, which you will compare with the recoverable value, which is 10 lakhs, and hence there is a impairment of 2.25 lakhs. Now this impairment of 2.25 lakhs is to be attributable first to whom? Well, this will be attributable first to goodwill and then to the other eligible assets. Okay, so if I do this working, let us say I will say that 2.25 is your impairment loss, and out of this impairment loss of 2.25, 1.5 is attributable towards goodwill and the remaining 0.75 is attributable to the other assets. These other assets will be machinery A and machinery B. You will not impair inventory because it is already measured as per Ind AS 2. Now, how much of this loss will be borne by machinery A and how much of this loss will be borne by machinery B? Well, it will be in the ratio of carrying value, that is 75,000 into 5.25 upon 5.25 plus 3.5 in the ratio of the carrying value. So this is, I think, if you sit and calculate, this will come to around 45,000. And this will come to around 30,000. So this is in the ratio of carrying value again. This is 75,000 into 5,25,000 upon 5,25,000 plus 3,50,000. And for machinery B, 75,000 into 3,50,000 upon 5,25,000 plus 3,50,000. So in general, you would have said, ke chalo, allocate the 45,000 impairment loss to machinery A. But if you allocate the impairment loss of 45,000 to machinery A will come to 5,25,000 minus 45,000. That comes to 4,80,000. However, if I go to see the individual recoverable value of A is telling the world that I'm capable of recovering. If I look at A, I'm telling the world I'm capable of recovering around 4,89,705 or 4,50,000, whichever is higher. That is 4,50,000. That is 4,89,705. So I cannot bring the value of A below 4,89,705, and hence the maximum impairment loss that A will bear. So if I go to see the maximum impairment loss which A can realistically bear is 5,25,000, and you can say that okay, at least it will give you 4,89,705, and as a result 525 minus 4,89,705, and this will probably come to 35,295. So if A bears out of the 75,000 maximum 35,295, it will not bear 45,000, then the remaining 75 minus 35,295, that is the remaining loss of 39,705 will be borne by B. So over here, your allocation of impairment loss will not be 45 and 30,000 to A and B. In fact, it will be towards A 35,295 and towards B it is 39,705. So this is a very interesting adjustment that you will have to do, and hence after booking this impairment loss, if I were to do the workings for A, B inventory and goodwill. My goodwill will become 0. 1,50,000 minus 1,50,000 is 0. A will be 5.25 minus 35,295. This is 489,705. B will come to 3,50,000 minus 39,705. So this will come to 3,10,295. Your inventory continues to remain at 2 lakhs only, and hence if I total all of this, my total carrying value will now be revised to 10 lakh rupees as on 31st March 2018. Now going forward, what is happening? In the next year, that is 31st March 19, the company has done assessment of the recoverability of the CGU, and the value of such CGU is rupees 11 lakhs. That is on 31st March 19. So this is the next year. So next year, if you want to find the carrying value, you will have to depreciate machinery A. For the remaining 5 years, you will have to depreciate machinery B, and inventory, well, whatever is the revised inventory you will take. If nothing is going, you can assume that the opening inventory and closing inventory remains the same. It's a realistic assumption that you even do in CA Inter FM. The recoverable value of machinery A is 4,50,000 and the combined machinery A and B is 7,60,000. So if only machinery A is capable of giving me 4,50,000, machinery A and B is giving me 7,60,000. So the additional 3,10,000 can only be earned if I club machinery B along with A. 7,60,000 minus 4,50,000. You are required to compute the carrying value after impairment as on 31st March 18. We have discussed that. And second, the prospective depreciation for the year 18-19. Now this is very easy. Prospective depreciation, you will say that now A is appearing at 489,705. A has to go down to 50,000 because salvage value is 50,000 over the coming 5 years, and hence the depreciation, if I go to see for A, would be, let's say, 489,705 to start with, and then this would be, let us say, 489,705 minus 50,000 because I have to go down to 50, and now 1 year has gone by. So if I do the workings over here, this will probably be equal to, I think, where is this working? 87,941. You can do this working, 87,941. Similar working will be done for B, where you start at 3,10,000. 295, and then you will depreciate, but this time around there's no salvage value, so this is directly to be divided over the remaining 7 years. 3,10,000, 295 divided by 7 into 1, and hence this depreciation, if I go to see, will be 44,328. So this would be your depreciation amounts, 44,228, and hence you will try to find the carrying value on 31st March 2019. A year later for machinery A, which if you go to see is 4,01,764, for machinery B is 2,65,967. Now your CGU still comprises of inventory, and if nothing is given, inventory continues to remain at 2 lakhs because opening stock can be assumed to remain same as closing stock, and you can say goodwill is 0. So if I try to find the carrying value of the entire CGU a year later, it will come to approximately 8,67,731. Now for whatever reasons, you have actually determined the recoverable value, which is 11 lakhs. So there is no further impairment. However, assuming there is an improvement in service potential, there can be a possible reversal of impairment. Now reversal of impairment cannot be done for goodwill, but it can be done for other assets, and as a result you will see possibly if there is a reversal possible for machinery A and machinery B. So when you go to machinery A, you first try to find that what will be the carrying value had there been no impairment. Had there been no impairment, machinery A would be at 5,25,000. Now this 5,25,000 you would depreciate by 1 more year. So 5,25,000 minus 50 divided by the remaining 5 years, that will give you another 95,000 of depreciation, and hence you will come down to, let us say, 4,30,000. So had there been no impairment working, your carrying value would come down to 4,30,000. For machinery B, this would be at 3,50,000. Remaining 7 years, no salvage value, another 50,000 of depreciation, and you would have come down to 3 lakh. So your carrying value, had there been no impairment, would have been 4,30,000 and 3 lakh rupees. The recoverable value, as you found, for machinery A is 4,50,000 and additional value attributable to machinery B is 3,10,000. So you'll compare this with 4,50,000 and 3,10,000. You can say that your asset, that is A, is capable of giving you 4,50,000, but had there been no impairment, you would still be at 4,30,000. So you'll select whichever is lower, and hence the carrying value, had there been no impairment, would have been 4,30,000. Again, for machinery B, you will take 3,10,000 or 3,10,000, whichever is lower, that is 3 lakhs. But what is your actual ledger balance? Sir, my actual ledger balance is 4,01,000 and 2,65,000, and hence is there a possible reversal? Well, yes, 4,30,000 minus 4,01,000 will be your reversal. 3 lakhs minus 2,65,000, that is 34,000 will be your reversal, and reversal you will add. So basically you will start at 4,01,000 and you will say, well, you can reverse 28,000, that is machinery account debit to PNL for reversal of impairment loss. Again, machinery B account debit to PNL 34,000, and hence you will come up to 4,30,000 and 3 lakhs. You can't go beyond that because that will be an indirect revaluation. Inventory continues to be at 2 lakhs and there will be goodwill. Now a student can always say, okay, sir, I can see the recoverable value is 11 lakhs, so let us assume the inventory is the balancing figure. That is not appropriate. It is very much possible that your value increases because there is a higher reputational value as well, but you can't reverse impairment of goodwill, and as a result you will restrict this to 9,30,000. Recoverable value is 11 lakhs, but your carrying value can very well be lower than the recoverable value. It cannot be higher than that. So it's a fairly complex question. We have just tried to discuss this question. Hopefully you have kind of been able to kind of match up the important areas over here. Otherwise, it is something that you will have to sit and study in detail. It is also similar to an exam question which had come recently, I think in May 23 or so, for around 10 or 12 marks. Okay, next is again a question which has come. It's a much more easier and a manageable question, but this is on allocable as well as unallocable corporate assets. So over here, ABC has 3 cash generating units, A, B and C, which are given to you. So carrying amount and useful life is given. It also has 2 corporate assets which have a life of 20 years. Okay, X of 600 carrying value can be allocated on a reasonable basis. Y 200 carrying value of Y cannot be allocated on a reasonable basis. So Y is unallocable corporate asset. X is allocable. Recoverable amount is given to you for A, B and C, and then for ABC Limited as a whole. You are required to calculate impairment loss, if any. Now for impairment loss, you will have to first do a 2-tier impairment testing, where you will first look at the smaller CGUs and then go to the larger CGU. The smaller CGU over here is A, B and C. Now A, B and C can have 500, 750 and 1100, but this is before allocating X or Y. Y cannot be allocated, but X can be allocated. Now X will be allocated in which ratio? Well, on a reasonable basis, a CGU which has a bigger size will utilize more of the corporate asset, but a CGU which has a longer life will also utilize the corporate asset for a longer period, and as a result the appropriate ratio for allocating an allocable corporate asset will be the product of carrying value and the useful life. And hence if I multiply, this will be 5,000, this will be 15,000 and this will be 22,000. So your appropriate ratio for allocating 600 would be in the ratio of 5:15:22. If you sit and do this working of 5:15:22, this is 71, 214 and 315 being the allocation. So over here, if I want to calculate the carrying value of these items, the carrying value of machinery of the unit A will be 500 plus 71, this is 571. For B would be 750 plus 214, I think this is 964. Okay, and for C this is 1100 plus 315, this is 1415. Again, there is no allocation of Y over here, but X has been fully allocated. You will compare this and try to see if there is any impairment. In A there is no impairment because 571 and recoverable value is 600, so you can recover more. For B there is a 64 impairment. For C there is a 15 impairment. Now out of this 64, first attribution will go towards goodwill, but there is no goodwill, and hence the entire 64 will be attributed to the corporate asset X as well as the other assets in the CGU B in the ratio of their carrying values. Here you don't take the carrying value into the useful life, you will take the carrying value as required by Ind AS 36. So if you allocate this to X and to other assets, so to X I think your allocation of 14 will be taken, and to the other assets 50. Again, when I do the allocation of 15, it will be in the ratio of carrying values, so that is in the ratio of 315 is to 1100, and hence 15 will be allocated. 15 into 315 upon 1415, so that will come to approximately 3, and the remaining 12 over here you can do the calculations. So over here what will happen is, post your smaller unit impairment, your CGU A will still continue to appear at 571, no impairment. CGU B will appear at 964 minus 64 of impairment, so this will appear at 900. CGU C will appear at 1415 minus 15, and hence this will appear at 1400. Now can I show X separately? The answer is no, because X has already been allocated to A, B and C, and hence the carrying value of X along with the impairment, if any, on X has already been attributable to A, B and C, but Y has not yet been allocated. So if I look at Y, 200 rupees will be separately worked around. So if I look at the larger CGU, that is ABC Limited as a whole, to which you can even allocate Y, this will be 571 plus 900 plus 1400 plus 200, and hence this will be 3071. You will come, so this is the carrying value of the entire unit compared with the recoverable value of 3200, and hence there is no further impairment. But over here, if your recoverable value, for example, was, let us say 3050, then there will be a 21 rupee impairment, and that 21 will entirely be eaten up by Y only, because the other items A, B and C, including allocable X, are already at their carrying values like A, or the recoverable values like B or C, whichever is lower. They will not bear any further loss. Any further loss, if any, will be taken up by Y only. Again, why do you do a two-level impairment testing? Because if I were to do this working directly, I could have said that, okay, for ABC Limited, why do I want to do it twice? If I take directly 500 plus 750 plus 1100 plus 600 plus 200. So if I do this working directly, this is 500, 750, 1100, 600 and 200. This is 3150, and you compare 3150 with 3200 and you will say there is no impairment, but as a matter of fact, there is an impairment in B and C. Just that because you are doing everything together, maybe that impairment loss is getting offset by probably the gains in, for example, units like A. Like in inventory as well in Ind AS 2, if you have three categories of inventory, cost or NRV, whichever is lower, has to be done category wise. So you will do it category wise. So here also you will try to do the impairment for A, B and C separately, and then so that you can check whether there is any further impairment in Y, you do a larger impairment testing. So that is the rationale why you do a two-tier impairment testing, and you don't do it at one shot. And if there is an impairment at the larger CGU, that will always go to the unallocable asset only. This is question 2, again an important question and has come in the past in the exams. Okay, next you will go to question number 3. This is regarding that parent subsidiary case. So on 31st March 11, Vision acquired 80% of the equity shares of Mission. So Vision is the acquirer, Mission is the target, for 190 million. So this is like the PC. The fair values of the net assets of Mission were included in the CFS of Vision on 31st March 11 at 200 million. So this is like your net assets. You will take over 100% of the net assets. It is a group's policy to measure the NCI at the date of acquisition at the proportionate share of the fair value of the identifiable assets. So it is a group policy to measure NCI using proportionate net assets method. And as a result, if I go to C, if I want to find the working as on the acquisition date, PC plus NCI minus net assets, your PC is, let us say, 190 for an 80% stake. Net assets are, let us say, 200. NC has a 20% stake to be measured as a percentage of net assets. 200 into 20% will come to 40, and hence your goodwill over here will come to, for example, 30 rupees. But this is goodwill attributable to only the 80% stake that you have acquired, called as partial goodwill. On 31st March 14, Vision carried out its annual review of goodwill on consolidation of Mission and found evidence of impairment. This is on 31st March 14, so probably 3 years later. No impairment had been evident when the reviews were carried out in 12 and 13. The review involved allocating the assets of Mission to the 3 cash generating units and computing the value in use of each unit. The carrying value of the individual units before any impairment adjustments are given below. So this is before any impairment adjustments, these are the carrying values. So you have been given intangible PP as well as current assets. Current assets like inventory, if they've given, well, they will be a part of your CGU. But have you even considered this goodwill? Well, if it is allocable, this goodwill will be allocated. It is not possible to meaningfully allocate the goodwill on consolidation to the individual CGUs, but all other assets are allocated as in the table shown above. So you cannot allocate the goodwill. You cannot take an appropriate ratio and allocate the goodwill, because as a matter of fact, the question says it is not appropriate to allocate. And as a result, over here, you will do the impairment testing at 2 levels. First for the smaller CGU, that is A, B and C, and then for the entire unit, I think Mission Limited as a whole, which includes even the goodwill. So if I look at only A, B and C, is there any impairment? I don't have the net selling price. So is there any impairment? For A, I'll compare 170 and 180. There is no impairment. For B, 90 and 66. So I think 90 minus 66, 24. 90 minus 66, 24 must be the impairment. And for C, again there is no impairment because the recoverable value of 104 is greater than the carrying value of 100. Now this 24 will be attributable to whom? Ideally first to goodwill, but there is no allocable goodwill, and then to other assets, that is intangible assets. Is that eligible? Yes. PP, is that eligible? Yes. Current assets, is that eligible? No. Ind AS 36 does not allocate any impairment loss to the current assets like inventories. Intangible assets of Mission have no ascertainable market value, but all the current assets have a market value which is at least equal to their carrying value. So current assets will not bear any loss. The value in use of Mission Limited as a single CGU is 350 million. Okay, that is for the company as a whole. Discuss and compute the accounting treatment of the impairment of goodwill as per Ind AS 36. So first I'll have to do the smaller impairment testing, for which unit A and C there is no impairment, but for B there is impairment. Now this 24 will be attributable between intangibles and PP in the ratio of their carrying value, that is 10:50. So basically you will have 24 into 10 by 60, that is I think 4, and 24 into 50 by 60, that is I think 20. So I will say 10 minus 4 and 50 minus 20. So this will come to 6. This will individually come to 30. And for current assets it will still be 30, and hence you will come down to 66. So this is your carrying value for the unit B. Now if I look at the company as a whole includes, for example over here, if we go to see for the company as a whole, it includes unit A, which will continue to appear at the carrying value, I think, which was 170. Unit B, which will now appear at 66. Unit C, which will appear at 100. But apart from that, there is goodwill. Now this goodwill is attributable to Mission Limited as a whole. So the recognized goodwill that you can see is to the extent of 80% stake, which is 30 rupees. However, when you compare it with the recoverable value, which is 350, is for the entire Mission Limited, and as a result you will have to create some unrecognized goodwill. Now if no other ratio is given, you will say that if 30 rupees is for 80%, then for 20% it will be how much? So if you do the working, I think this comes to 7.5, and hence 37.5 is the entire value of the goodwill. Now this will give you a number which you can compare, for example, with the recoverable value. I think this is 373.5. Now this 373.5, you will compare it with the recoverable value of 350, and hence there is an impairment loss over here of 23.5. Now this 23.5, if you were to allocate, will be first attributable to goodwill and then to other assets. Now how much will be attributable to goodwill? Remember, this 23.5 is calculated based on 373.5 minus 350. In the 373.5, you have taken 37.5. Not just 30, 37.5, and hence we will say that this goodwill of this impairment loss of 23.5 will first be attributable to goodwill, but this good and nothing else is going to the other assets. This goodwill is out of 373.5. 23.5 has to be removed, but within 373.5 you have 37.5 worth of goodwill, and that 37.5 is not just attributable to parent, it is attributable to parent and NCI both, and hence out of this we will say 80% is attributable to parent, 20% of this is attributable to NCI, and hence if I do the working, 23.5 into 80%, this will come to probably 18.8, and the remaining I think 4.7 is attributable to NCI. So will you record an entry to write off 18.8? Answer is yes, because this 18.8 comes out of this 30. 30 is there in your books. You can impair an asset which is appearing in your books. But this 4.7 comes out of this 7.5. Now this 7.5 is not appearing in my books. I can't impair a non-existent asset, and hence my impairment on goodwill will be 18.8. So in my ledger the goodwill appears at 30. Not 37.5, 30, and that 30 I will reduce by 18.8, and hence the remaining goodwill I think of 11.2 will continue to appear. So over here I think if we go to see over here, 18.8 will be recorded, 4.7 is pertaining to unrecognized goodwill, and hence there is no separate impairment. So compute the accounting treatment of impairment of goodwill. So out of the 30, 18.8 will be subtracted, and hence 11.2 will be the remaining goodwill which will be there in your books, the remaining. Technically, you can say 7.5 minus 4.7, but because 7.5 is not appearing, you cannot impair out of a non-existing goodwill. So these three are the important questions. I hope this video has been helpful. I'll see you soon with another video. Till then, bye-bye and take care.